We have Vipul Prasad of Magad Capital to talk more about markets. He's a stock picker at heart and, of course, manages the portfolio for his clients as well as for himself. Vipul, thank you so much for your time. Long time we haven't spoken. What's your hypothesis on this market right now after having seen almost 1.5 years of very range-bound kind of and especially for mid-caps, it has been a brutal year?
Thanks, Ajay, for inviting me to the show. It's always a pleasure to be here with you. So on the market, the way we are looking at it, that it's going to be volatile for the next 6 months, definitely. But overall, for fiscal 24, especially towards the back end, we expect at least some improvement. The thing to look at is that in the US, the macro outlook is still a bit muddled. Having said that, one must also say that at least we are clearer about the targets and goals of the policymakers. The Fed has come out very clearly that inflation is right now their topmost priority, and they'll do whatever it takes to control it. Even if it means we go for a shallow sort of recession. So that's the broader outlook in terms of the US markets and the US macro. As far as India is concerned, I think we are looking like an oasis, not just in terms of growth, but also in terms of the fundamental backdrop. So we were very disciplined when it came to stimulus in the COVID days, and that is helping us now. Also, the RBI also has managed to go about its monetary policy in a very graded fashion. So there have not been any knee-jerk reaction, probably the kind of reaction that we saw in the US. So in that sense, we are looking very well placed. But of course, in the last 1.5 years, we have not done too well in terms of market performance because the valuations have got stretched. So in that sense, I'm saying that probably, and now, after the relative underperformance in the last 18 months, we have come down to historical average levels in terms of P multiples. So under 6 months of this kind of a sideways movement should be expected. But beyond that, the kind of strength that is there in the economy, the kind of gains that we can see from the reform process that has been unleashed, and the kind of infrastructure build-up that we've seen, I think we look good from a 2-3 year perspective, definitely.
What are your thoughts on this issue of slowdown? Do you think Indian corporates will be impacted as well? Because some mild trimming of growth estimates has happened. Is it likely to happen in earnings growth estimates as well of Indian corporates, or not yet, or not to that extent?
I would say that especially in the first half, we can see some slowdown. But in the second half, probably we'll be in a much better position, because we also have to remember that most of the corporates have done a great job in terms of stabilizing their balance sheets. Some of them have also managed to expand their capacities in the last 2-3 years to take care of, to tap the market growth that is happening in various sectors. Many sectors are there. And the credit growth that is likely from here, I think we are in for better times. But yeah, coming back to EPS growth, I think first half will not be too great. But second half onwards, again, we should get into the groove. Let's say 13 to 15%. Of course, last 6-7 years have not been particularly great, except for the last 2 years. Before that, it had been a story wherein all the analysts and investors would start the year with, say, okay, mid-teen growth, and then they would keep on scaling it down. But this year, I think it has to be a slightly different story. We'll start from more graded expectations, but as the year progresses, we'll start moving up. And if we talk of sectors where probably we can expect good numbers, banking is something that we should see the momentum continue. Similarly, in infrastructure, again, the momentum should continue. There are some sectors like defense, we should see that. In IT, we probably will see further compression in not just top line, but also in terms of margins. So margin probably will not move up from here as many people had been expecting. So yeah, that's the backdrop that we should be looking at. And in terms of overall EPS growth expectation, we are building in something around mid-teen growth for the full year fiscal 24. And next year, it should be higher.
Vipul, what is your biggest overweight in your portfolio?
We are talking of sectors. We are very positive on banks. When I say banks, means not just BFSI, just banks, corporate banks and retail banks, and generally larger ones, but we also have some decent exposure in the smaller banks in the public sector space. Then in terms of overweight, if I see, because banks in any case are very, very big sector in terms of its exposure in the indices, Nifty 50 or Nifty 500. But just the overweight terms, we are heavily overweight on defense sector.
Is pharma also something which you have started looking at? Because it hasn't gone anywhere in last 1 week, some action is happening. And if yes, what side? Domestic pharma or overseas exporters?
I am still not convinced on pharma because the kind of lack of pricing power that has been seen in the last 2-3 years, I don't think that has yet been resolved. And I don't see any signs of it getting resolved in the next, say, near term. So at least 1.5 years. On the top of that, some companies have managed to improve their margins, and obviously because of the correction in raw material prices. But to that extent, they have gained, and to that extent, they're still gaining. But that base effect is also going away now because they have been managing to improve their margins for the last 3, 4, 5 quarters. So from here onwards, the bottom line growth will probably be in line with their top line growth, which is not going to be very exciting. Having said that, I must say that pharma is not bad in terms of valuations. Very unlike IT, in pharma, the valuations are slightly lower than historical averages. But still, we have growth of 5-7%. I will not be very excited to get into this sector at this point in time.
Watching defense, I think you like defense space as well, because the valuation in many pockets appear high, and the earnings actually are very lopsided, concentrated in few quarters or years, and orders take long to, come into fruition. How do you analyze that and buy?
Yeah, so in defense, one has to be selective in the sense that private sector defense, their order books are smaller, they are executing faster because their scales are smaller. And that's why, in terms of their revenue growth and profit growth, has been much better than the public sector companies. And that's why their valuations are kind of stretched. For me, the public sector defense companies are looking in a very good shape because they are the ones who take the integration job. Because right now, a big change has happened, especially in the backdrop of Ukraine war, that all of a sudden Indian armed forces are looking at Indian defense suppliers more constructively. Earlier, they used to be very skeptical about Indian defense companies' capabilities in terms of both quality as well as timeline. Now they are realizing that in case of an emergency, you'll have to fall back upon domestic sourcing. And that's why the kind of order buildup that is happening is sort of unprecedented. We have never seen this kind of order book for most of these large integrators. And that's why, coming back to your question, first, the trading performance has been great, but still it doesn't mean that valuations have gone up to a level where you'll say that, okay, now not worth touching these stocks. Secondly, as you rightly pointed out, that these are long gestation projects. Most of them are, say, between 4 to 6 years. That's why on PE probably will not show up because today something gets added to your order book. It'll start impacting your earnings and cash flow after, say, 3 to 4 years at least. So that's why once you do a DCF sort of analysis, then you realize that in terms of cash flow, it's looking great. And that too, there's a high level of certainty for these orders. So they will come, and now that your scales are expanding, you're also being able to do some more work on designing also, not just in manufacturing. So your average return ratios will also improve from here. So that's the point that we are making when we are taking positions. Of course, we have taken positions in these companies.
What else do you like from mid-cap, small-cap end of the basket, which you have been researching?
So yeah, but again, we have not bought them from the perspective that we are buying because we need to have exposure to mid-cap and small-cap, but they're looking very interesting. I mean, some of these companies, for example, and of course with the usual disclaimers that we have exposure to these companies, and this is not a sort of a recommendation to buy or sell, but let's say something like a PG Electroplast or Varun Beverages, we are having exposure to Power Mag. We have KI industry. So these are all small cap and mid cap. Varun Beverages is more towards large cap now. But the thing is that they are all benefiting from some industry-wide tailwinds. but they're all in their own rights doing very well, going up to challenge the leaders. So, or a company like Varun has already established itself as a leader in one side. So, and in the last 3-4 years, they have expanded scale big time, which means their return ratios have risen dramatically. And now also with the copious cash flows that they have enjoyed in the last 2-3 years, they are using it to expand their capacities further to tap the market because the markets are growing. So in this sense, some of these names are looking very interesting. And even if right now, if on a trailing basis, their PE multiples look a bit stretched, but if you are able to take a slightly longer term view, you'll realize that they are looking very interesting even now because you have a very high visibility on their earnings growth.
All right, Vipul, we'll let you go on that one. Thanks so much for joining us on the show today. That is Vipul Prasad of Magad Capital.